Tractor Supply Stock, ticker symbol TSCO. On the 26th of October, TSCO presented a quarterly report where they beat on EPS but missed on revenue. For the upcoming earnings, all analysts think they will miss. Year to date, the stock is down 7%, which is very interesting. It never fully recovered from earlier decreases. And people love TSCO stock because of multiple reasons, and one of them being the dividend. And I understand why, with dividend yield at 2% and a 5-year 28% compound annual growth rate. So could this be the perfect moment to buy TSCO stock? Well, I'm very excited to see what you guys think about this stock. So please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Tractor Supply do? Tractor Supply is the largest operator of retail farm and range stores in the United States. The company targets recreational farmers and rangers and has little exposure to commercial and industrial farm operations. In here we see the third quarter results. Revenue was reported at $3.41 billion, up 4.3% year over year. The comparable sales growth decreased 0.4%, which concerns me a bit. TSCO can easily generate more revenue by opening new stores, but you want the existing stores' growth in revenue as well. Comparable transactions was flat, but comparable ticket declined 0.3%. Gross margin increased 101 bps, which is a great number. They are improving the margins at a pretty high rate. That is also reflected in this sheet, where operating margin is increasing at a high rate. Both the net income and diluted EPS are also growing at high numbers. For the full year of 2023, TSCO expects to report 14.5 to 14.6 billion in revenue, with a flat comparable store sales, which comforts me a bit. Operating margin is expected to be in a range of 10.1 to 10.2%, which is a small increase from the current margin. To me, this looks really good. And now that we know a bit more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. TSCO is a 21 billion market cap company. PE ratio is at almost 19, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for TSCO stock, so make sure to watch until the end. Because PE ratio is only telling a small part of the full story here. Revenue is at 14.9 billion, and in this graph we see that revenue went up in the long run. However, in the past couple of quarters revenue was slowing down a bit. This same event is also reflected in the margins. It's going up in the long run, but went down a little bit. Most recently it is increasing again. EPS is looking really good with some high growth numbers year over year. Analysts expect that from here EPS will pick up a higher pace. To me this looks really good. For the revenue, analysts expect pretty much same pattern, but with lower growth numbers. But again, looking really good to me. Return on assets is sitting at 7.8%, which is a decent number. Return on equity looks really good, but the most important number, return on invested capital, is sitting at 17.5%, which is a great number. And it is also a little higher versus the 5-year average, which is also very nice. Current ratio is at 1.52, which is looking pretty good. There is nothing really special to mention here. Right now TSCO has 5 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. TSCO has roughly 420 million in total cash, so they can't pay down a big part of the debt. To me, this doesn't look good. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, but it is not always steady and consistent. Shares outstanding are decreasing, which is something that I really like. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2%, which is a great number. Annual payout is at $4.12 and payout ratio is at 39%. I prefer 50% or lower, so right now they have 61% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at 28%, which is an insane number. And they have 11 consecutive years of dividend increases. And if you take a look at these numbers, the dividends paid since 2012, you see that TSCO did increase the dividends at a high rate. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that it is increasing over the years, but nothing that concerns me a lot. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at a decent growth level in the future. Overall these dividends look pretty good to me, but how about the historical returns? I decided to compare TSCO with the overall market, in this case the S&P 500. On the 5-year chart we see that TSCO beats the S&P 500 big time with 120% return versus 76% return for the S&P 500. This result is including dividends. On the 1-year chart things look pretty different for TSCO with a minus 4% return versus 16% return for the S&P 500. On the 6-month chart it is not looking any better with a minus 15% return for TSCO. And the S&P 500 sitting at 9.5% return. On the 1-month chart it is again the S&P 500 beating TSCO, but this time only a small difference. Bottom line, TSCO beats the S&P 500 long term, and short term it looks pretty interesting. So with the stock hammered down lately, could this be the perfect time to buy TSCO stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6, 7 and 8%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 8, 9 and 10%, and for the free cash flow margin I'm putting in 6, 7 and 8%. For the PE ratio and the price to free cash flow I'm putting in 17, 18 and 19. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now TSCO stock is at $206. I hit analyze and we see only a few green numbers. We have a low price target of $131 to $175. We have a mid price target of $171 to $220 and we have a high price target of $220 to $272. To me the mid to high price target is the most justified here, indicating that this stock is undervalued. My final conclusion is that TSCO is a great company. It has been on my watch list for a long time. And now that I have covered it for the first time in a bit more detailed way, I'm getting more excited about the stock. I think next year is going to be crucial for this company. Revenue growth and comparable sales growth is slowing down a bit. So are they capable of growing again or will it decrease from here? All other fundamentals look pretty good to me and the dividend growth is what gets me really excited. I do expect lower dividend growth numbers in the future, but still at least double digit. Valuation is also looking pretty interesting with the stock being undervalued in my opinion. For now I added them to my buy list, and whenever there is a small drop to let's say $180, I start a first position I think. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.